Hi there, this is Aubrey Chauke. I'm a tutor for accounting, business studies, EMS, as well as research. If you are watching this lesson right now, you are at the right place. Please don't forget to subscribe to our YouTube channel by clicking the subscribe button on your bottom right. Today in our lesson, we're going to be talking about non-current assets as well as current assets. Before we start by explaining our two main concepts, we firstly need to start by understanding in general what are we talking about when we talk about assets. Assets are the resources that are owned by the business. And these resources that are owned by the business, they can sometimes be in a form of cash, or sometimes they can be in other commodities that can be converted into cash. For example, we can have an asset in the form of inventory. We can sell that inventory to be able to change it into cash. And sometimes we can have assets straight as cash. For example, the money in the bank, the money in the petty cash, your cash float and so forth, it's already in the form of cash. But then sometimes you find out that we have assets, but they are not yet cash, and then we'll need to sell them so that we can convert them into cash. So assets, just remember that not all assets are in a form of cash. Some will need to be sold so that they can become cash. We have two forms of assets which are known as non-current assets and current assets, which is what we'll be focusing on in this lesson. As we proceed with the presentation, I'll be differentiating between non-current assets as well as current assets. And I hope that after this lesson, you'll be able to make sense out of this. As stated before, there are two kinds of assets, and this include non-current assets as well as current assets. We are now going to focus on non-current assets. Non-current assets are the assets or the resources that the business has been having for a long period of time, which is usually more than 1 year. For example, if you look at businesses like the ones in transportation, you will realize that most of them have been having their assets like taxis and trucks for a long time. And then one thing about non-current assets also is that they take time to be converted into cash. The reason why they take time to be converted into cash, it is because they cost a lot of money. For example, you'll find out that a quantum costs around, maybe let's say 350,000. It will take you time for you to be able to sell that quantum. And remember also that people don't always have money available. Somebody may be needing to apply for a loan for them to be able to buy that particular quantum from you. So one thing about non-current assets, they are not easy to sell. They take time to sell. If you look at things like houses, it takes time for somebody to be able to buy a house. Some end up having to take up some bond loans to be able to buy houses, and then you'll find out that they are paying maybe over a period of 20 years. Most of these non-current assets that businesses have, they cost a lot of money and they take time to be sold. And one thing about non-current assets is that they can be converted into cash in a period that is greater or that is more than 12 months. As I stated before, non-current assets usually cost a lot of money for the business to buy. Then to prove that they cost a lot of money for the business to buy, you will realize that when it comes to non-current assets, businesses will need to have meetings with the board, the board of directors and the shareholders. They will need to have a meeting to be able to discuss how they are going to invest in these non-current assets. And then people who are employed to run organizations that have such resources, they don't just take decisions on their own to be able to buy those assets. Because these assets cost a lot of money, they end up having to consult with the board, the shareholders and so forth. So the people who run those businesses, your marketing directors, they don't take decisions on their own. And this is because there is a lot of money involved in buying these non-current assets. And then one thing that we also need to be able to remember is that non-current assets are divided into two categories. The first one is the physical assets. When we talk about physical assets, we are talking about assets that can be touched. You can think of something like a house, you can touch it. Something like a vehicle, a delivery truck, you can touch it. And then when you look at that, when you look at a house, it takes you more than a year to be able to raise the money to buy that house or to build that house. It takes you a lot of money that you can't just pop out right now. Some people end up having to save money to be able to afford that property that they want to buy. So when we talk about physical assets, we are talking about assets that can be touched. You can see them with your own eyes. You can touch them. I mean, you can touch a vehicle. You can touch a delivery truck. You can touch land, things like that. And then we also have financial assets. Financial assets are usually invested in institutions like banks. Financial assets can also be through security stocks. So we need to be able to understand this. We need to be able to differentiate between the physical assets and the financial assets. Just remember that in terms of financial assets, we are putting money in other institutions. The money is not within our institution. Then in terms of physical assets, we are talking about your land and buildings, your vehicles, and your equipment, as I stated before. Financial assets, we are talking about fixed deposit. As an organization, we may decide to take out some of the money that we have earned as a business and to say, okay, we want to have a fixed deposit with ABSA. How about we take this money that we have in our business and invest it in ABSA so that it can earn some returns? That money, when we prepare our financial statements, that investment that we have made, it will have to be reflected in our non-current assets. Okay, and then if you also check, when you prepare your cash flow statement, you also have a section that is called cash flow from investing activities. If you check, when you invest, you will invest in things like property, vehicles, and so forth, right? So you will look at such things. What non-current assets have we put our money into? You can decide to put money in a fixed deposit in a particular bank, and then that will be your asset. You can go there after some particular period and claim that money. Hence we're saying that remember, it's called a fixed deposit, so meaning that it grows at a fixed rate. There's a particular percentage in which that deposit that you have made earns interest. And we also have security stocks. In terms of security stocks, there are some companies maybe that are not in line in the same business as ours that are operating. We can decide to invest in maybe, let's say, for example, public companies. We can decide to invest in a public company by buying their shares. If it's not maybe in the same business with us, we can decide to invest in that business and say, okay, we are putting money in your business, but then we are expecting some returns. If you check guys like Rupert, that guy has got shares in many companies. Like, I've never seen someone in South Africa who has shares in many companies like him. He has invested in security stocks, he has invested in big brands, the food we eat and so forth. So security stocks are different, but I won't get into that right now. The next item that we have to talk about is called current assets. In terms of current assets, one thing about them is that the worth of current assets, the worth of such assets usually frequently changes. You can look at the worth of things like inventory. Things change. If maybe, let's say, we are a business that sells phones, maybe let's say we are selling iPhone 12, and then it happens that there's an iPhone 13 coming, the worth of our iPhone 12 will be lower at a time when iPhone 13 is introduced. So in terms of current assets, their worth frequently changes, is not constant, and then most of the time current assets they can be converted into cash within a short period of time. And then another thing is that current assets are sometimes already in a form of cash. You can look at things like your cash float. Cash float is not a lot of money. That change that you use when you sell to people. You can look at your petty cash, that cash that you use to spend on small items like tea bags, paying people who are earning on a weekly basis. Maybe let's say if we have a gardener whom we pay 100 rand per week, or maybe 200, we can take that money from the cash, the petty cash, and pay that person. And then another thing is that in terms of current assets, if they are not already in a form of cash, they can be converted into cash quickly. If you remember earlier at the beginning of discussing current assets, I spoke about their worth changing, and I also made an example about iPhone stocks. Let's say maybe if we are selling iPhones in our business, we can be able to sell iPhones quickly as compared to when we sell things like vehicles. iPhones will go quick. So even if they are in a form of inventory, we are able to convert those iPhones into cash at a quick pace. Okay. And then the other thing is that current assets are divided into 3 parts. We have the inventory. In terms of inventory, we are talking about things like trading stock, consumable stores on hand, packaging material on hand, stationery on hand, if maybe we use stationery in our business. Anything that we're using that was on hand, it will be part of our inventory. So as I was saying, things like your stationery on hand, packing material or packaging material on hand, and so forth, the trading stock that we were supposed to sell but we could not sell, maybe because it's the end of our financial period, it will be part of our current assets. It's more quick to sell your stock in the business. It won't take you more than a year. Hence, we are saying that current assets can be converted into cash in a period that is less than a year or less than 12 months. So when you talk about the inventory, just remember, we're not just talking about the trading stock that was left remaining. We are also talking about your consumable store, stationery on hand, packaging material on hand. Anything that is on hand that was supposed to be used in the business will form part of the inventory section under the current asset. And then from there, we would have what we call trade and other receivables. Trade and other receivables, think of it in this way. As a business, when you sell products, you can decide to sell on cash, but then sometimes you can also sell on credit. Big businesses like your Edgar's, your Jet, and so forth, they sell to customers on credit. You can be able to buy products on credit, and then they will collect that money at a later stage. So that money that they collect from the debtors, they will record that under trade and other receivables. Just remember that trade comes from the word trading. Okay, so hence they're saying trade and other receivables. It means that it involves the money that is collected, that is related to the trading that takes place in the business, especially on credit. And then we also have cash and cash equivalents. We're talking about money here, any money that can be converted into that is already in cash. Some of them are not in cash, remember. Like the money in the bank. Sometimes if you have the money in the bank, remember that money, fine, you have a card, but you don't have that hard cash right at that moment. But then you can decide to say, okay, let me go and withdraw this money and have it in hard cash. Your petty cash is already in cash, so there won't be a need for you to be able to convert it into cash. And as I stated before, that in terms of the inventory section, we are talking about trading stock, consumable on hand, consumable stores, and so forth. Okay. And then trade and other receivables, as I stated before. In terms of trade and other receivables, I remember when we started this part of current assets, I said that trade and other receivables, it relates to the money that we collect that is related to selling, especially in terms of selling on credit. Remember, If you are a business that sells on cash only, you will not have debtors. The major part of trading other receivables is debtors control. If you check, when you compare all the other elements in the trading other receivables notes, you realize that debtors control is always high. And this is because the debtors control constitute the money that we have received from the credit sales that we have made. And obviously, when you sell on credit, those people, they don't pay you immediately. They probably wait after a particular time, like 30 days. You can make an arrangement with them to say, guys, I want you to be able to pay me 30 days after you have bought my products on credit. We have terms and conditions for collecting money, and then you sit down with your customers to say, okay, this is how you're gonna pay me. If you pay me during the first month, I'm going to give you maybe a discount of 5%. And then mostly some businesses allow their customers who bought on credit to pay over a period of, I think, 2 months or 3 months. It will depend on the store and then on how much money does the business collect on cash sales. And then another aspect that is included is prepaid expenses. Those expenses that you have paid in advance. Remember, pre meaning before. So prepaid expense, those expenses that have been paid before the expense was incurred. Like, for example, I can prepay my rent. I can pay my rent in advance without me having stayed for those months that I've already paid for. If we're in August, I can pay in advance for September and October. That money to us as a business, the ones who are paying that money to our landlord, that money will be regarded as an asset to us as a business, because we have not yet experienced that we have not yet occupied those premises or properties for those particular months. So anytime we can go to our landlord and claim our money. This means that this person actually owes us that money, so hence it's an asset to us. Then we also have accrued income. As a person who is in business, it can happen that people don't pay you as they were supposed to. Maybe let's say that we were supposed to receive income for rent and that income becomes delayed. Those people will owe us, so hence we have accrued income. Thank you so much for watching. We have come to the end of our lesson. God bless you.